Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada, and I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Can you believe that it's already middle of December? As we are gearing up to wrap up the year, I'm also going to share with you a bunch of tax changes that's happening for 2024, so then we can look ahead and prepare for those. But before I dive deep into the details, make sure you give us a thumbs up if you like our video, or share our video with people who would find it useful. If you have any comments or questions, make sure that you leave it in the bottom of the video so then I get the first-hand feedback from you, so then I can keep improving our channel and provide better information to all of you. Now with that, let's get started. The first changes is the marginal tax update. For those of you who are not familiar with our Canadian personal tax system, our Canadian personal tax system operates on a progressive tax system, which means that the more money that you earn, the more taxes that you would have to pay. Now, every single Canadians out there are entitled to a set of different marginal tax rate. The way it works is that when you earn, let's say when you earn $100,000, the first $12,000 in Ontario at least is not going to subject to any tax. And then between the $12,000 and $15,000, you're subject to Ontario tax, which result in 5% tax rate. And that 5% would be applied to the delta between $15,000 and the $12,000, which would result in $158 of tax payable. And then the next tax bracket would be $15,000 to $49,000. And between the income between the $15,000 and $49,000 is going to subject to 20% of tax rate. So the 20% is going to be applied to the delta between $49,000 and $15,000. So the $34,000 delta would multiply that by 20%, and that would come up with $6,863 of tax payable for the next tax bracket, and so on and so forth. Essentially, for someone who's making $100,000 in 2023 in Ontario, there is an estimate tax payable of about $22,128. Now, these tax brackets are being adjusted on an annual basis by our Canadian government to reflect the inflation amount as well. So in 2024, as you can see, the tax bracket has been adjusted. And so the tax bracket for someone who's making $100,000, same $100,000 did not get a raise, that person would be paying $21,658 in 2024 as compared to $22,128 in 2023. So there is a small decrease in terms of tax payable on an annual basis, given the amount of tax brackets change from year over year. The next big change is the CPP calculation for 2024 and onwards. We had done this particular video in the past, so make sure that you refer back to this particular video and the link in the link above, so then you can get the first hand in terms of details of how CPP has been changed from one way to another. Basically, for anyone who work in Canada as an employee, you're required to contribute to your Canada pension plan as part of the deal living as Canadian. Now, what this Canada pension plan does is that when you contribute, it's the government's way of forcing Canadians to contribute to their pension plan and eventually getting something back when they retire from the government, from our Canada pension plan. And the contribution amount is typically decided by our government. And in 2024, the amount has been increased to 5.95%. And there was a gradual increase over the last few years to raise it to 5.95% and of your salary. Now, there is also a maximum amount that you would contribute to this CPP. The maximum amount that you would contribute in 2024 would have been increased because there is a second tier of contribution being imposed. So the first tier is going to be applied to the earned income up to the first ceiling, and the first ceiling is $68,500. And there is a second ceiling that an additional amount of 4% that would be applicable to the delta between the second ceiling and the first ceiling. And so the first ceiling is $68,500 and the second ceiling is $73,200, which means that there would be an additional $188 that's required to be contributed. For details, make sure that you visit my other videos to understand how this change would affect you. Now, if you're a self-employed, obviously you are your own employer, and if you're self-employed, you would be required to contribute that amount by 2 times as well. So instead of an added cost of $188, now you have an added cost of $376. So a little bit more than what you would otherwise need to pay. Some people ask the questions on as to, hey, like, is it worth it to contribute CPP? How do I avoid paying CPP altogether? Because at the end of the day, CPP contribution, maximum contribution for 2023 as a self-employed individual would be at $7,735. So it is an added cost that you would otherwise need to pay to CRA. So depending on how you look at CPP, some people look at CPP as savings, some people look at CPP as a contribution. So if you're on the side that believe that CPP is a saving, then by all means continue to contribute to it. If you're on the camps that CPP is an expense and you want to eliminate it, make sure that you contact your professional accountant or contact us to give you advice on how to avoid paying CPP in general. The next update is on RRSP contribution. The third things that we need to update you on. The RRSP contribution limit in 2024 is raised to $31,560. Now, I don't know if everyone is familiar with how RRSP contribution is being calculated. RRSP contribution is basically a contribution to a tax-deferred saving account for retirement purpose, and the contribution limit is typically calculated based on 18% of your earned income. Now, for someone who wants to achieve that maximum RRSP contribution limit, that person would need to make $175,333 in terms of annual salary to achieve that $31,560 of maximum RRSP contribution limit. And you have until February 29th, 2024 to make a contribution to your 2023 tax year. So then you can make the contribution to deduct in 2023. Now, if you're unsure as to whether you should make the contribution in 2023 or in 2024, or if you're unsure if you have the RRSP contribution room to do that, and you know that you're expecting the salary to increase your RRSP contribution room, it's always a good idea to contribute in the new year. So then you have the flexibility to deduct that contribution. You have the option to choose to deduct that contribution either in 2023 or in 2024, because then that basically gives you the flexibility to choose to be deducted in different years. Now, RRSP contribution are tax deductible against your taxable income, and hence allow you to deduct some of the taxes, pay less tax in your immediate year that you earn the income and you make the contribution. And the way that it works is that in the later years when you retire, when you're not expecting to make as much money from your day job, you can then take the money out from your contribution RRSP plan and then spend the money and pay way less tax. As I showed in the earlier marginal tax rate update, if you earn less income, you pay way less tax at that time. So this is how RRSP works, and it's always something that Canadians can use as part of the tax planning tool that every day everyone can use to help them lower their taxes. And there are many different ways for people to use RRSP contribution as a way to split income. This includes splitting income with yourself, so you can contribute RRSP and get it deducted against income this year, and then maybe withdraw it next year if you're planning for retirement or if you're planning to take a sabbatical. So you can play around with how you want to split income with yourself. The other way to The other way to split income using RSP is to contribute to your spousal RSP account. That is one way to help you to split certain amount of income with your spouse. And there are special rules that govern these type of income splitting. Make sure you consult with a professional accountant that understands these rules before you implement your plan. The next update is the tax-free saving account. The tax-free saving account contribution limit for 2024 has been increased to $7,000. It's 2 years of consecutive increase, because last year the contribution room has been increased to $6,500, and this year the government has allowed another $500 of increase to $7,000. If you have never contributed since 2009, and assuming that you also qualify to contribute, you're over the age of 18 and you were a Canadian, you have been a Canadian since 2009, and you are over the age of 18 at that time in 2009, since the TFSA has been implemented and by the Canadian government, you would have a cumulative contribution room of $95,000. If you make any overcontribution to TFSA account, you would be required to pay a 1% penalty per month on any amount that's overcontributed. So make sure that you don't break that rule. Now, the next topic that I want to update everybody is the Canadian Dental Care Plan benefit. Now, this Canadian Dental Care Plan benefit, it was hot off the press today, basically is targeting anyone who has a household income under $90,000. And for people who are uninsured, there is no insurance coverage provided by their employer. So this will cover people, this will be implemented in 2024. They would start accepting application they will start accepting application from now, and then it will be fully implemented to everyone who are eligible, that's age 18 and above, sometimes in 2025. So this will be carried out over the next little while. And if you make the income, that is your household income, is below $70,000, you do not need to make any you do not need to make any payment for any cover services. If your household income is between $70,000 to about $79,999, you will see a 60% of the service fee covered by the government, and then you would have to pay the other 40%. Like for anyone that is earning income, the household income is between $80,000 to $90,000 income tax bracket, then the copay jumps to 60%. So the government is only picking up 40% of the tab, and you have to cover 60% of the cost. So what does this Canadian Dental Care Plan cover? Dental Care Plan cover? Well, it covers any cleaning, any examination and x-rays, any restorative services, including fillings, crowns, and dentures. So basic stuff, including oral surgery, extraction, deep scaling, everything that you would do at the dentist that require preventative and diagnostic and restorative services, a lot of them are covered under this plan. So for those people who have household income that are under $90,000, and provided that you do not have any coverage anywhere else, you would be eligible to apply and get accepted. As a matter of fact, the Canadian government will send you a letter to invite you to apply to the program as well. So stay tuned if you are one of those people who qualify. Next update is the first home saving account. Well, as we mentioned last year, the Canadian government has introduced this particular account called First Home Saving Account, FHSA account. This account is introduced by the government as an incentive to Canadians who have never purchased their home or who qualify, who is deemed to be the first-time home buyer. Just be cautioned though, first-time home buyer does not include necessarily just the first-time home buyer. If you've never used a first-time home buyer, if you do not live in a house that you or your common partner co-own in the past, you would be eligible to, you are considered as first-time home buyer, and therefore you would also be qualified to contribute to this first home saving account. A classic example is some of my clients would purchase a rental properties and they never live in a property that they own. They would still be qualified they would still meet the criteria as the first-time home buyer, and therefore they would then qualify to have a first home saving account. Now, we get that out of the way. I just wanted to share that this plan, First Home Saving Account, was introduced in 2023, and the maximum contribution limit to it is $8,000 in 2023. Now, in 2024, the contribution limit would still be $8,000 in 2024. The contribution that you have not made in 2023, you would be eligible to make it in 2024 as a 1-year carryover. You can only carry over 1 year of contribution limit to the next year for contribution. Now, another important fact about First Home Saving Account is that the saving has to be used for the purpose of buying your first home. So when you withdraw from the accounts, you would not need to add it to your income tax return. So kind of like TFSA. But the contribution you make to this HST account would be completely tax deductible against your income, and kind of like RSP. And also, the saving or the investment income you would otherwise make in this first home saving account would be completely tax sheltered. FHSA is a hybrid between RSP and TFSA, so you get the best of both worlds. You get the deduction, but you also get to use to grow it on a tax-free basis. And when you withdraw the money to purchase your first home, you would not need to include that as an income. Which is very helpful for Canadians who are trying to get in the door to buy their first home. So the next topic that we're going to talk about is revised Underused Housing Tax Act. In the 2023 fall federal economic update, the government has come out and recognized and shared that they're going to make some changes to this Underused Housing Tax Act. And what is it? If you're a real estate investor, you're fairly familiar with this Underused Housing Tax Act. Essentially, when the government implemented it in 2022, earlier in 2023, they released the form and they also released the legislation, and it's supposed to be applicable for 2022, December 31st, 2022, on residential units at 4 units and under. So if you have a 5-plex, then your property would not be affected at all. You don't have to worry about UHT. If your property is a single family home, condo, duplex and triplex, your property will be caught under this Underused Housing Tax Act. Then you may or may not have a filing obligation. Now, under the old rule, essentially, anyone that is a Canadian corporation that's owned by Canadians, Canadian partnership, or Canadian trustees that own a corporation in trust for someone else, they would also get caught under this Underused Housing Tax Act. Even though the original intention promoted by the government was to make sure that the non-residents are not buying properties that are leaving them vacant and not providing the housing supply that the Canadians need. But because of how the legislation is written, Canadian corporation, Canadian partnerships, Canadian trustees were all caught under this rule, even though they have no tax to pay because there's an exception for them not to pay any tax. Now they would still, under the old rule, under the original rule, they would have filing obligation. They didn't have a choice. So in 2023 fall economic update, they had recognized I wouldn't say the loophole, they had recognized the issues that that was contained in the original legislation. So now they come out and they also recognize that the filing obligation required and the additional cost of compliance imposed on the small scale landlord. So in the fall economic update, they came out and they said, hey, we're going to eliminate the responsibility to file these tax returns, to file this Underused Housing Tax Act form for Canadian corporations, for Canadian partnerships, and for Canadian trustees. So for this group of people that are truly Canadians, that are not meant to be caught under this particular Underused Housing Tax Act, they would no longer have the tax filing obligation from 2023 and onwards. But for 2022, these group of people would still have the filing obligation. But the Canadian government has extended the deadline for filing twice, and now the newest deadline to file for 2022 is April 30th, 2024. So for those of people that are caught under the old legislation in 2022, you would still have the same filing obligation in for 2022, but the deadline has been extended to April 30th, 2024. But for this particular group, you will no longer have the same filing obligation from 2023 and onwards. So a little bit of good news. And guess what? The reason why we have this good news, my guess that they are taking away the filing obligation for Underused Housing Tax Act, because they're now imposing this trust reporting rules in 2023 and onwards. With this new trust reporting rule, we've already covered it in detail in a different YouTube video above, so make sure that you click that link to get a better understanding of this trust reporting rule. Essentially, what this trust reporting rule does is that CRA has implemented and making sure that all the Canadian trusts with or without income, bare trusts, or foreign non-resident trusts, all these trusts would have no filing obligation under the old rules because they would have no income for one way or the other. They would have no income, and therefore there is no filing obligation. But starting from January 1st, 2023 and onwards, if you have those trusts exist during the year, you would need to file a tax return, a trust tax return, to CRA, notifying CRA that, hey, there is a trust relationship that's happening. Even though there's no tax to be paid, but you still would need to file for the tax return. Now, this particular trust reporting rule affects people, not just to Canadian real estate investors, but also regular day-to-day real estate investors. Now, let me explain a couple of commonly affected examples. For people who own properties whose name is being added to, say, your parents or your grandparents' property, to help them with dealing with the day-to-day issues such as paying property tax bill, calling the city for changes and certain things. Your name is had been added to title, but you do not own any true ownership of the property. And under this situation, your title is being added and you're really owning the property in trust for your parents or grandparents, for the sake of really dealing with all the hassles of owning the property. Now, there is a filing obligation under this trust reporting rule. And again, for more detail, make sure that you visit my other video up there, so then it would help you to get a better understanding of your filing requirement. Now, the next update is the short-term rental deduction. The Canadian Federal Economic Update. In the fall, the federal government decided that from January 1st, 2024 onwards, if you are operating a short-term rental in an area where they do not allow short-term rental to happen, you are operating short-term rental in those areas, and you're not supposed to. The municipal government does not allow you to operate short-term rentals, such as the case in City of Toronto or Vancouver. If you're operating short-term rental in those areas illegally, you are now not eligible to claim any deduction at all against the income that you collected from short-term rental starting January 1st, 2024. This really sucks because a lot of us are doing short-term rental in order to bypass the landlord-tenant board issue, and also a lot of us are doing that so then we can actually get to a cash flow neutral position or make some money off our portfolio. Now, because they came out and changed all the rules around this particular area for municipalities and cities that have rules that prohibit short-term rentals to happen. So this is brand new and it started to be effective January 1st, 2024. So make sure you get registered or make sure at least you do something in preparation to this anticipated change if you own a short-term rental in the areas that are affected. Okay, this has been a long video. I promise this is the last topic that we're going to cover. As a matter of fact, there is one other topic which is not relevant to most individuals, so I'm not going to cover that. Now, this last topic is about GST and HST on purpose-built residential rental that are 4 units and over. So single-family home condos and 3 units, they're not qualified for this particular update and change at all. So if you are building a property and you had start building a purpose-built rental building that are 4 units and over, and if you start building after September 14, 2023, these new rules will be applicable to you. Under the old rule, when you build a brand new home, whether it's single family home all the way to multiplex, you are required to do a self-assessment on the fair market value of the property when the property is completed, especially when you are building a purpose-built rental unit. So this means that it's adding a lot of extra costs of operating the rental and essentially discouraging people from building more rental units. Now, the government has recognized that, and the federal government recognized that, the Ontario government recognized that. So they both came out and said, hey, from September 14th and onwards, any construction that started after that particular day, I don't know why they picked that day, but any construction that started after that day, pretty much all the way till 2030 or 2035, you would be eligible for an enhanced HST rebate, which allowed the builder to claim 100% of the HST that they would pay to CRA as a result of the self-assessment on the fair market value of the property at the time the property is ready for occupancy. Those are all the updates for 2024 that I could think of that are relevant to a lot of real estate investors. So if you have any questions, make sure you leave it in the comment section below. And if you like our video, make sure you give us a thumbs up. And as always, share this video with people who are interested or who may find this video useful. Until next time, happy Canadian real estate investing.